Hi, everyone. I hope you all had a nice weekend. So as we're waiting for everyone to kind of settle in, I do have a question for the audience. So in light of the recent market turbulence, what's your biggest concern moving forward with your investments? And then you can use the question section of your GoToWebinar control panel to answer. And then feel free to let us know where you're tuning in from as well. We always like to hear. And then I was trying to think about my biggest concern. And I think my biggest concern during market volatility is figuring out how to spot the right opportunities without really getting swept up in all the chaos. So John, what kinds of challenges have you encountered or any concerns that you've had in the past when dealing with rocky markets?
Well, yeah. Hi, Jenna. Welcome. It's interesting. I graduated from college back in the summer of 1987. And I guess if you're a market historian, you might remember something called Black Monday, where where a 500 point drop in the Dow was a big thing. Um, so I was quickly exposed to the volatility that the market can have and the impact it could have on emotions. Fortunately, that was a very short-lived, it was very steep, but very short-lived market correction, bear market. But over the years, I've experienced many bear markets, and as like anything in life, I think once you go through something a couple of times, you learn to live with it and you learn to become comfortable with it as long as you have a long-term plan. I think the key is having an understanding of history, how it interacts, and being in the right position to either take advantage of any kind of market downturn or know what it might have. I mean, for me, it's now that I have got young adult children that are getting established in their careers as well, is trying to instill in them the whole notion of how to invest early and often and how to stay with the market and how to build an appropriate asset allocation and live off it. So for me, it's a question of just simply having a plan in place, one that you could live with, having a system in place and sticking with it. So it's obviously emotionally difficult thing to live with, but the more often you do it, the easier it becomes. I mean, I guess when you see a tight wire act, and I can't imagine walking a tight wire, but these people do it as young children, and they're probably doing it just a foot off the ground, and they learn how to balance, and they learn how to deal with that kind of risk, and balance and go forward with it. So that's how, for me, it's become that kind of situation. And I've enjoyed interacting with our members over the years. And I think as investors, there's two big risks. There's the FOMO, fear of missing out, chasing the big winners, and then there's panic, and that's the almost other extreme end of it. So trying to balance between FOMO and panic. Panic's not a strategy.
I couldn't agree more. And I like the analogy too. That's great. All right. Well, I think everybody's kind of settled in, so I don't want. I know we have a lot to cover tonight, so I want to get started. So, hello and welcome to this evening's webinar, Volatile Markets: How to Stay Calm and Invest Smarter in 2025, led by our team of analysts. And thank you so much for joining us. We are always happy to have you all here. So, my name is Jenna Brashear, and I'll be your host for today. We're really glad to be here this evening with our team of analysts. We're really looking forward to diving into a variety of topics, during this presentation. But before we begin, there are a few things I'd like to go over. So first off, I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. So every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And so be sure to keep an eye on the chat throughout the webinar. We'll be sharing helpful resources and some key insights on staying ahead during market volatility. And then we've also put together a great set of materials that we'll email to all attendees later this week. So you'll have them handy whenever you need them. And then if you have any questions for our speakers during the presentation, because I know you'll probably have a lot, so please submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, our moderator, John, will select a few for the analysts to answer. And then if your question isn't selected during the broadcast, you can feel free to email us at members@aaii.com, and I'll put that in the chat later today. And then you can find the presentation slides in the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And then feel free to follow along using the handout. And then it will also be emailed to all attendees after the webinar. And then if you experience any issues with the audio or the video of the webinar, please consult the gotowebinar.com or website for support at gotowebinar.com. And then just a friendly reminder that this presentation is recorded and a replay of the webinar will be sent to all who attended today. And then the PDFs and the recording will also be accessible at aaii.com/webinars. And then for new viewers, we always like to give a little background about our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to John.
Well, thank you so much, Jenna, and welcome everybody to our special panel that we've assembled today. We've gotten a number of comments and questions from our members. Given the current market volatility, I think we've gone from an environment where people were excited for the new administration. They expected a tailwind with perhaps decreased deregulation, a sort of a pro-business administration, to one where there's a little bit more uncertainty, a little more of a headwind. We have got a little bit more of a push as far as tariffs with a unknown specific strategy in place, which just created a expectation of perhaps of greater volatility, greater market uncertainty, greater economic uncertainty. And as such, the market's one of the best discounting machines out there in the world. And the market has sort of taken a step back, both the stock market and the bond market, as far as what does the future hold. Perhaps there is a greater chance of economic downturn. Perhaps people aren't certain of what the strategy is as far as tariffs are concerned. We are seeing a continuation of the immigration policy going in place. So I think a lot of uncertainty is in the air, and when things are uncertain, people tend to pull back. Consumers are pulling back, businesses are pulling back, and everyone's kind of reassessing the environment in that context. So I thought it'd be very helpful just to kind of give a little bit of a historical perspective on the market. It is said that while the market doesn't always repeat itself, it does tend to rhyme. And that's the case of the history. So I think, what our goal today is with our assembled analysts here is to give a little bit of a sense of, what has the market achieved in the past? What do market downturns look like? How often do they occur? What does the current market valuation look like? What kind of actions can we take as an investor? What kind of action should we take as an investor? Are there any tactical things that we should perhaps pursue as investors, given any kind of opportunity that might occur even during a market downturn? And also, we want to touch upon some of the tools that you as a member have access to when it comes to our website and other resources. So, with that, I'll be acting as the moderator today. My goal is to try to look at the questions you guys are submitting and toss it over to our analysts as we go along. So please feel free to go ahead and toss in questions in the chat. I'll do my best to kind of pepper them during the presentation to our presenters here today. And with that, I'm going to actually have everybody kind of maybe do round robin introduction. I'd like to introduce Wayne Thorp. Wayne Thorp is head of all of our special publications, our newsletters, director of research, and he's been here, I think, for over 25 years now, if I'm not mistaken, Wayne. He holds a CFA charter, and he's in charge of our stock analytics here. And I think he provides an interesting perspective on the market as well. Do you have any comments when it comes to market volatility and what impact it's had on you, past or current?
Well, actually, my first experience to a major market downturn was also Black Monday, 1987, but mainly because that was my father's 43rd birthday. I was in 7th grade at the time. But I graduated in June from DePaul in June of 97. So my big first market downturn was the dot-com bubble deflating. So, that was quite a shock very early in my career. And I think, the biggest thing was it gave me, a healthy respect for volatility. But it's something to respect, not necessarily fear. And one of the things I've learned over my 25 plus years of investing and working at AAII is that volatility does create opportunities, and it's that volatility that gives the equity risk premium that makes stocks the best long-term investment. So, when the market starts wobbling, goes through periods of volatility, it's just always good to remind myself that this is a natural progression, a natural course path for the market, and just keep my head on my shoulders and look for any potential opportunities.
Wayne, you want to pass it over to Cindy?
Oh, certainly. And so I'll pass that on to another analyst, Cindy McLaughlin. Welcome, Cindy.
Oh, good evening. Thank you for joining us. I'm Cindy McLaughlin. I've been at AAII for a little over 2 years, so I'm probably the newcomer, very much the newcomer among the group here. And my first experience with market volatility, I had been really carefully saving and keeping my head down, but the dot-com bubble, and I will call that the tech wreck. I worked in telecom at the time, and that was just not a very pleasant thing. Everybody's worried about their portfolios and their jobs. So I think the biggest thing that I learned was maybe just keeping calm, staying the course, and that also helped me through the great financial crisis as I left telecom and transitioned into the financial services industry. So that's the biggest thing that I learned. And as John and Wayne have both spoken about, finding opportunities and looking at one of life's challenges as here's a good opportunity, just figure out how to use it and make some good investments, stock up on some things that seem rational, and don't panic or look at this as something that's the end of the world. So with that, I will introduce Charles Rotblut.
Thanks, Cindy. Hi, I'm Charles Rotblut. Probably many of you know me as editor of the AAII Journal. I'm also the editor of our dividend investing newsletter. I've been with AAII for now, I guess, 15 and a half years, and time flies. But I guess that puts me in the middle of the pack as we're talking. But in terms of bear markets, I think like Cindy, my first bear market I really remember was the dot-com bust. And one of the things I learned from that, and that actually got me to start reading Ben Graham, to start learning about psychology. But even after 2008, I realized one of the things that helps is that you can't predict where the bottom is going to be. But one of the things I'll talk about in a few moments is myself. I like to try and buy the market. If I see stocks falling down 20%, I usually try to put some more money into stocks. And I had a conversation about this over the weekend with somebody, that the average correction, well, the corrections bottom at 20%. The average bear market, as I'll show you in a few minutes, doesn't go below 30%. So if you look at buying, say, down 15, down 20%, you may not hit the bottom, but you'll probably be close enough to the bottom that your additional downside won't be great, but your upside is greater. And I think for a lot of people for investing, we tend to focus on the downside, not thinking what's typically happened, what additional downside do I have, and is that additional downside tend to be less than a potential upside. So it is a weighing game all the time. And obviously, when we talk about strategies like this, there's certainly a psychological component, and you need to be comfortable, realize that you may not hit the bottom, but you're doing it because your time horizon is longer than the bear market or the correction's going to last.
That's interesting, Charles. I mean, I know you put together a number of slides for us. One kind of giving us a sense for how the markets reacted, really, I guess, since the election. Do you want to, any particular observation you want to make about this chart?
Yeah, and so I think I put together because I think it's helpful to take a step back, because there's just been so many headlines going out. And if your head's spinning, -2. It's hard to keep track of everything that's going on. In fact, I updated this Friday afternoon, and since then we've had headlines about electronics possibly being exempt from some tariffs, and now today talks about perhaps automobiles won't have necessarily the same tariffs. But one of the things that you notice at this downturn is pretty recent. Up until about February 13th, the market was at its high of pretty close to the high. It was really until we started hearing about Liberation Day, about reciprocal tariffs being announced on February 13th. You can see on this chart, after the third bubble, where things start to drop down. I'm tempted to point at the chart on John's screen, but that quite won't work online. But one of the things you have to realize is that the stock market is forward-looking. And so when you look at that drop from February down through March, even through last week, that reflects the uncertainty of traders trying to price in what's going to happen with earnings. And it's not just on the stock side. We saw this on a bond side as well, particularly last week, where we saw bond issuances by corporations just get frozen because creditors were trying to figure out, well, what's the company's ability going to be to repay the debt? So right now, we're really looking, and this really makes it unusual this time, is we're really looking at political uncertainty, not business uncertainty, but it's that uncertainty of what exactly are tariffs going to be, what impact are they going to have on earnings, both corporates from the stock side and from the bond side, and how does that get resolved? And I think that's one thing that's very unique about this, is we are dealing with political uncertainty, not business uncertainty. This is not economy's overheated, there's too much inventory, valuations got too heated, and granted, some valuations were high. This really is political in terms of tariffs and what is tariff and economic policy going to be going forward. And obviously we can throw in a little bit of tax uncertainty as well, but that's really taking a back seat to the current tariff situation.
Well, how has, given this level of uncertainty, how has that impacted the sentiment survey itself? Actually, I seem to be having like switched. There we go.
Yeah, so this is interesting. One thing we've seen this year in sentiment is we've seen individual investors, or AAII members specifically, but it's not just AAII members. We've seen this in other measures of sentiment too, where we've seen people getting very bearish and optimism really dropping before we've actually had a huge market drop. And yes, the stocks have fallen, but technically we have not really entered a bear market in stocks, and yet we're seeing numbers representative of a bad bear market. For instance, a couple of weeks ago, bear sentiment spiked to its third highest rating in our history. We've done this survey weekly since 1987. Ballpark, we have about 1,800 weekly readings. And a couple of weeks ago, bear sentiment had its third highest reading ever at about 61.9%. So again, had this huge spike. And the other two times were 2009, March 2009, as you all know, right when the global financial crisis bottomed. And the other time was in the fall of 1990s, where we had the first Gulf War. We had the economy pulling back, and we had that bear market, that really market correction then. So two big events that were already going on, excuse me, but this time we had actually the fear what's going to happen really driving sentiment. And again, it wasn't just our sentiment survey. I saw among professional investors. I saw other measures of sentiment measuring individual investors, where you see these really spikes in bear sentiment. So that made this unusual. But one thing I will say, what we tend to see among AAII members is that sentiment tends to shift a lot faster than allocations. So you AAII members have done a really good job of not letting your psychology drive your allocations, which is really important, because it's okay to be concerned or fearful about what's going on, but it's not okay to make changes to your portfolio over fear of what you think might happen when your emotions are running hot. And I should add real quick that realize that when sentiment is really off kilter, particularly when you see optimism being really low or pessimism being really high, that historically tends to be a really good buying opportunity. There's that old saying about buying when there's blood on the streets. I like to say, is buy when everyone else is afraid to buy, because you have the absence of buyers, causes stock prices to drop. And when stocks are on sale, that's a great time to buy them.
Yeah, and this chart here I think is interesting because it tends to highlight a couple of things in the sense of how often we as investors can anticipate market drops and the tenure of them. This is a history that goes back, since really post World War II. Any particular notes you want to point out here?
Sure, a few things. First of all, look at that second column, the numbers. Pullbacks and drops are really common. We've had 62 pullbacks, which is a drop between 5 and 9%. Corrections, we've had 24, and bear markets, we had 14. So to put those kind of perspective, about every 14 months, the stock market has dropped between 5% and 10%. So it's a drop from the S&P 500's high. Certainly throw in other indexes, you actually have those a little more frequently. Corrections, a drop of 10 and 19%. That happens about once every 3 years. Currently, we're in a correction because we have not had a close in the S&P 500 below 20%. And that really is a benchmark for determining what a bear market is. And I've yet to see a correction happen where people aren't talking about bear markets occurring, about recessions occurring, but they do tend to bounce. And then bear markets, a drop of 20% or more, those happen approximately once every 5 years. So these stock market drops are pretty common, and they're a normal part of market cycle. And fear and doomsayers and that pit in your stomach, that's typical. That's just normal human behavior. But one thing to realize is, looking at, John, if you move over to the next column where it says average drop from peak, the losses tend not to be really bad. Corrections tend to bottom up at about 14%. Bear markets, most bear markets don't fall more than 30%. So people think about the bad, financial crisis, global financial crisis. We had about a 38% drop in the stock markets. You think about 1973, or you think about the dot-com bubble, really bad bear markets. Those tend to be the exception, not the norm. Most bear markets end before they fall 30%. And even the coronavirus bear market, we had a huge drop, got down to the high 20s, and then it rebounded. The column next to it, where you see time to low, the market, Mr. Market likes to take the elevator down. And I like to say Mr. Market likes to take the high speed elevator down, the kind that move really fast that your ears pop. So if we have a correction, it tends to bottom within 4 months of it happening. Most bear markets tend to bottom within 10 months. And time to recovery, look at correction, about 4 months to get back to the highs. For a bear market, you're looking at about 13 months to get back to the high. So that's actually to full recovery. And keep in mind, when you have a bear market, they say a start of a new bull market is 20% off the bottom of the bear market. So this is actually months to gain you back to break even. So if you had $1 million in your portfolio, bear market happens, you're investing in S&P 500 solely, and after the bear market bottoms, you're talking about 13 months after bottoming to get back to even. So about 2-year period or so, you've gone through the ringer and you're back to where you started from before the bear market. So if you just hold, you get back to where you tend to break even much quicker than people actually expect it to happen.
And I guess a couple of points here that's worth highlighting is that this information is a reflection of the S&P 500, and we know that different, at least occasionally, all the different market segments tend to move the same. But there are times where perhaps you've had situations where large caps dominate for a while, and then small caps, and we have tech stocks. This, just as a reminder, this is really specifically talking about the S&P 500. We have had, in some ways, probably a weaker market for some of the small caps for a longer period of time. Any other thoughts about that?
No, I think that's a good point you call out, because if you go back to, say, the dot-com bust, small cap stocks really started soaring well before large cap stocks did. And if you look at the current market environment, what we've seen right now are your dividend paying stocks have held up better. Your low your low volatility stocks, your stocks with low betas have held up better. So, and we've seen the NASDAQ really drop more than S&P 500. So one case of diversification is if you hold different types of stocks, your whole portfolio is not going to move at the same time, at the same degree, or necessarily in the same direction. So that does make a big argument for having a diversification. All market measures tend to be based on the S&P 500 or the Dow, and it's important to realize the Dow is 30 stocks, the Dow Jones Industrial Average. The S&P 500 is 500 stocks, and there's ballpark about 4,000 exchange-traded stocks. And so the headline numbers you hear aren't necessarily representative of what all stocks are doing at any moment in time.
And hopefully your crystal ball is nice and sharp and clear. Joe was asking, it seems like in many cases, there are bear markets that are caused by economic events, and we know that, when it comes to most economic indicators, we had jobs reports last week. Many of those are lagging the economy. They actually, the unemployment rate is probably one of the last things to really change after the economy starts to either improve or go down. But we also know that kind of contrast to that, really the stock market is one of the best leading indicators. The stock market tends to move up well in advance of the economy bottoming, and it tends to go down before the overall economy starts to go down. Given that, in some ways the current downturn, the current adjustments that people are making to the economy and the adjustments that people are making to the likelihood of a recession are somewhat self-inflicted. I mean, it's sort of a unique situation. Do you think that changes any of the analysis you're seeing here as far as market corrections?
I don't, but I will say this is a political event, and could we still fall into a bear market? Absolutely, and that's what makes it so hard to forecast, is that it's a political event. And while that makes the downside uncertain, realize that also makes the rebounding uncertain. So if your thought is, I'm going to go out now and wait for things to be all clear, by the time you start feeling good about the market, stocks could have rebounded considerably. And so we'll talk a little bit later about psychology and what you can do, but realize it's very tough to actually predict. And we individual investors, we see all information, but you're also looking at institutional investors with access to economists, more real-time data than we have available to, and they are ultimately the ones that drive market direction. And you're seeing their uncertainty being priced into the market as well. I don't have a crystal ball for what's going on right now, at least one that's not cracked, but neither does anybody else. And we are, unfortunately, right now at the whim of what tariff policy is and what it evolves to.
Now, long-term rates of return really we see these, typically quoted 9-10% expected rate of return in a typical year for stocks. Is that, what is the interesting part of this particular chart here? I mean, do we typically, is it 9%, so you get the small percentage over the course of the whole year, or are there kind of jumps to this type of thing? Wayne, I think you put together this interesting chart here for us.
Oh, absolutely. This chart, I think, is a good representation of a very important lesson in all of investing. It's a lesson that often separates long-term success from costly mistakes. Now, if you think about the stock market, looking at the period from 1928 through just last week, the S&P 500 has literally lived through it all. You've had the Great Depression, you've had recessions, you've had Black Monday, the Great Financial Crisis, even COVID. And still, if you'd stayed invested through all of that, your annual return would be just over 6% before dividends. Now, a lot of people would say, well, that doesn't sound like very much. But if you compounded that over the entire period, they'd give you a total price return of over 30,000%. But what if you'd missed just the 10 best days in nearly 100 years? Your return drops, and it drops a lot. Your total return is slashed by 2/3. Why is that? Well, that's because emotion, whether it's fear, doubt, or hesitation, oftentimes keeps investors on the sidelines. Now flip that. What if you avoided the 10 worst days over that period? Your return skyrockets to over 100,000%. But here's the catch. Those worst days often sit right next to the best ones. And no one, no algorithm, no expert has consistently predicted them in advance. So what if you missed both the best and the worst days? You can actually go back, John, I'm sorry. What if you
try?
So what if you'd missed both the best and the worst days over that 98-year period? Your return does improve, although slightly, but not meaningfully. And the strategy, it's still incredibly hard to execute, being able to time both those best and worst days. So here's the truth. Volatility isn't the real threat. It's emotion. It's getting spooked by headlines, jumping in and out, trying to be too clever. If your goal is to build wealth, don't try to dodge every storm. Stay on the ship, because over time, markets reward discipline, and discipline doesn't require brilliance. It just requires staying in. But now we can advance. Oh, go ahead. Sorry.
Before we advance, I have a question here for you, Wayne. So I know that people talk about being a buy and hold investor versus trying to do some long-term trend following, and I think there's examples of success doing both. So what you're saying, but what sounds like what you're saying though is that you basically want to pick a strategy that you believe in, whether it's relatively buy and hold, or whether you're going to be a trend follower and have a system in place. Because it sounds like what you're saying is that if you're going to basically do some trend following, and you might miss both the good days and the bad days, but you're going to potentially probably have I've seen most studies say you typically have a very similar rate of return, perhaps a little bit less risk or volatility. Whereas long term, if you want to get your rate of return, you have to be in the market the whole place. I mean, so I guess the key here is I guess have a religion and stick with it. Is that kind of the point here?
Yes, and I wholeheartedly agree. There you can quote unquote time the market through trend following and things like that. My opinion is the greatest benefit to those types of strategies is it does lower the volatility. Now, lowering the volatility does then typically reduce your long-term returns somewhat, but you are, you're cutting off the troughs and cutting off the peaks as well. So yes, you can either be that set it and forget it long-term investor, which a lot of people are. But then, you can be some type of a trend following investor as well. But I think, what this is trying to convey with this is the fact is, and it'll be play out more in the next chart, is it's very difficult to avoid, the bad because of how close the good often follows that. And yeah, so this is what you're seeing here on slide number 6. At first glance, this chart might look like a scatter plot of chaos, but it's actually one of the most revealing visuals that I've found for all of investing. Each X on this chart marks a day when the S&P 500 moved 3% or more. The green X's were up at least 3%, and the red X's indicate a day where the S&P 500 was down at least 3%. Now, this isn't just volatility, this is extreme volatility. The dashed lines show the 3% thresholds. The blue line, positive 3%, and the purplish line, minus 3%. So any X on this chart, that day meant something big. But here's what's striking. These X's don't appear randomly. They cluster. This is a very, very powerful visual representation. You see around the Great Depression in the 1930s, you have Black Monday around 1987, where you see the almost a straight vertical of green and red. You have the 2008 Great Financial Crisis, where again you see them very closely clustered together. And you have COVID in the early 2020s, and then you have a few additional X's now with the current tariff turmoil. So why does this all matter? Well, because during these clusters, the worst days often sit right next to the best ones. Looking back at the chart, think back to March of 2020. The market plunged one day, and then I believe it was March 9th. The market set its foot in the ground, and it sprung forward, and it continued to soar. So if you jumped out during the panic, you likely missed the rebound. And that's the trap. We treat volatility like a detour we can swerve around, but that's not a detour, it's the road. Trying to time the market sounds smart, but in practice, it usually means selling on fear, missing the recovery, and repeating that cycle. And with every round, your long-term gains erode. So this chart isn't necessarily a call to action, but it is a call to discipline. It says, don't flinch, because market storms are inevitable, but panic, that's optional. So the key is to stay calm, stay invested, and over time, those scary red X's, well, they'll become part of the story that built your wealth. So slide 7 here, now we're going to sort of shift gears and we're going to talk about the rhythm of volatility. And how often does the S&P 500 move 3% or more in a given day? Well, this chart has the answer. And it tracks how many trading days typically pass between those big moves, up or down. So look at the left side of the chart, and it shows something pretty wild. Nearly 1 in 4 times a 3% move is followed by another the very next day. And if you zoom out just a little bit and look at 1 to 4 days, it's more than half of all the 3% days occur within 4 days of each other. So what does this mean? Once the market gets volatile, there's a better than even chance another big swing is just around the corner. Now, these moves don't show up like random blips. Again, they arrive in clusters, like aftershocks following an earthquake. That's why you hear sometimes volatility begets volatility. And here's where investors get tripped up. They see a red X, they see a big down day, they get spooked, and they exit the market. But that next day, it could be the start of a rebound that they miss out on. Now, glance to the right side of this chart, those long, calm stretches. You know, they do exist, but they are very rare. And when the storm returns, it rarely comes alone. So from this chart, there's a key takeaway. Volatility isn't a bug, it's a feature of the market. It's not something to dodge, it's something to expect. If you're trying to time it, it's almost impossible. But preparing for it mentally, emotionally, and strategically, that's where the edge is. Because when you know when the waves come in sets, you can stop jumping ship every time the water gets choppy. You stay calm, you stay invested, and that's how you stay in position to grow.
So it sounds like kind of interesting because I know Charles was saying before, as an investor, you know, in a typical year, we could almost expect probably a 10% move just in a typical year. What does this chart here show us, Wayne?
So this chart actually reveals something that every investor must understand, not just intellectually, but emotionally. This chart, every blue bar on this chart shows how the S&P 500 finished a given year between 1980 and 2024. On the lower part, those orange diamonds, they mark the worst drop that happened within that same year. And then you have that solid yellow line on the bottom third of the chart. That's the average intraday drawdown over that period, which is almost 14%. And here's a powerful truth. Almost every year includes a correction, and that's a scare or a gut check for many investors.
Yeah, just so a drawdown is what the difference between is it a closing high and then the bottom? Is that so? Like as an example here for the first year here, looks like in 1980 the market itself was up probably somewhere around 25 or so percent.
Yeah.
But then over the course of that year, at some point in time, the market actually was down 17% from its high. So the drawdown is the
peak to trough.
Change, peak to trough. Okay, thank you.
Yep, absolutely. So even in strong years, you know, thinking back to 1985, 1995, or even 2019, the market pulled back 10%, 12%, even 19% before finishing up double digits in those years. Now, yes, there have been painful years like 2008 or 2022 where the market dropped hard and didn't recover, but those are the exception and not the rule. If you want the market's long-term upside, this is the toll you pay. Volatility isn't a flaw in the system, it's a cost of admission. You don't get to separate the good years from the drawdowns, they come as a package. The market has rewarded discipline, not avoidance. And it's not that the annual return that determines your outcome, it's how you handle the journey in a given year. Because when fear hits, headlines scream, and prices fall, that's when many investors flinch. They exit the market and they miss the rebound. So what's the takeaway from this? Volatility, again, is not the enemy. It's the entry fee for long-term growth. If you want the S&P's average annual total return of around 10% a year, you have to be willing to ride through those 13.9% dips in a given year. The investor who accepts that and stays the course, they're the ones who build real wealth.
In terms of expectations of return, does this give us a little bit of a sense for the kinds of returns we've gotten over time, and what are the key takeaways here on this slide?
Absolutely. No, I think this table here is a very powerful tool that a lot of investors can learn from. It shows the nearly 100 years of performance from 1926 to 2024 across different asset classes. Looking at the top, we're looking at average annual returns. And over that time, the S&P 500 has returned 10.4% per year, including dividends. Small cap stocks, even better, 11.8%. Now compare that to bonds. This is roughly between 3% and 6% annually. T-bills, a little over 3%. Inflation, just under 3% a year. So most fixed income barely kept ahead of the rising cost of living over this period. But the real story is the second half of the chart. If you had invested just $1 in the S&P 500 back in 1926, reinvesting all dividends, today you'd have over $18,000. Put that same dollar into small cap stocks, you'd have over $64,000. T-bills, just over $100. After inflation, less than $25. Now, this isn't just a return gap. That's the difference between building wealth and keeping up. So the secret here isn't just stocks, it's time and compounding. Compounding starts slow, but over decades, it becomes a force nothing else can match. And yet, many investors miss out, not because they chose the wrong asset class, but because they didn't stick with it. They again flinch during downturns, they chase what's hot, they let short-term noise override long-term vision. This isn't just a table about numbers, it's a mirror. It reflects what truly drives investing success: patience, consistency, and emotional discipline. If you want to reach the destination, you have to stay on the path.
Now, in terms of expectations here, it's kind of interesting. I see some rates of return have changed over time. If you want to invest in stocks, what does this chart kind of show? What impact time horizon has on that process?
Oh, absolutely. When people talk about risk in investing, a lot of people view risk as losing money. And that is a valid concern, especially depending on where you are in your investment time horizon. But here's what often gets overlooked is the longer you stay invested, the lower that risk becomes of losing money. This slide shows just that. It charts how often different asset classes lose money, depending on how long they were held. So let's start with the short term. Over nearly the past century, the S&P has had about a 25% chance of losing money in any given single year. For small cap stocks, it's closer to 30%. So yes, over a year, stocks are basically a coin toss. Even government and corporate bonds showed losses about a quarter of the time over 1 year periods. Only T-bills were nearly loss-proof over 1 year, though they barely beat inflation. But now what happens when we stretch out our time horizon? If you hold the S&P 500 for 3 years, the risk of loss over that period drops to 15%. For 5 years, that falls to 13%. 10 years, just 4%. But here's the big one. Over any 20-year period in nearly 100 years of data, not once did the S&P 500 or small stocks deliver a loss. Not once. And that's the truth investors often miss out. Investing is risky in the short term, but over time, the odds shift in your favor. Markets drop, there are recessions, there's scary headlines. All of that happens, but they also heal. Volatility is like weather, stormy today, but doesn't necessarily mean stormy forever. And if you zoom out, the climate has been reliably generous to patient investors. So from this, here's the key takeaway from this slide is time isn't just a cushion, it's your edge. The longer you stay invested, the less risky it becomes, and the more likely you are to win.
And I guess the key point here is that to some degree, time is your friend, but also you have to be cognizant of time. And your age may not be the factor that determines your time horizon. It could be when you actually need your assets and how many assets you have. So
Absolutely.
a young investor could have a relatively short time horizon, and an older investor could have a relatively long time horizon. So but understand that if you do need money from your portfolio, if you need to draw money out of your portfolio within the next, 3-5 years, if you invested in stocks, there's a chance it won't be up when you need it. That's really probably the big lesson here. But if you do want to gain that long-term rate of return, obviously, you have to have that you have to understand that there's a possibility of that occurring. That's probably true, I think, of even investing strategies, because I think the previous chart showed that last 20 years, small caps have underperformed large cap stocks. But we know long term they've outperformed. So it's almost I've heard, generally speaking, it could almost take 20-25 years for a given factor to really hold true, which is sort of challenging as an investor.
Well, even value versus growth. Long-term value tends to outperform growth, but over the last 20 years or so, value has lagged. But no, I think this chart, this table, I think is very important because when people talk about risk tolerance, often the de facto way to define it is where you are age-wise. Is if you are younger, you can accept more risk. If you're older, you don't want to accept as much risk. But it really does come down to what your holding period is. Because as John said, you could be relatively young, but if you're saving to buy a house and you want to buy a house in the next year or two, then your time horizon is short based on what you need that money for. Same thing, someone could be well into their 80s or 90s, and if they want to have a remainderment, pass money on to grandchildren, give it an endowment or anything like that, they also have a relatively short holding period, and they want to make sure that they're preserving that wealth.
Now, I thought this chart was interesting because I think, in your mind as an investor, you're kind of drilled into, well, I should expect 9-10% a year from my common stocks, right? But the reality is that typically at any given year, the chance of having a 9 or 10% return is pretty small. Is that any color here?
Oh, absolutely. I think this chart is a great illustration of what it really means to be a long-term investor. Each bar on this chart shows how often the S&P 500 delivered returns in a given range from nearly a century of data, and that's including dividends. At the top, again, we have that familiar number. The average annual return for the S&P 500, including dividends, has been about 10.4% over this period. But here's the catch. The market is never average. Rarely does it actually return 10.4% in a given year. This number is an average that's drawn from a wide mix of ups and downs. Now, if you look at the left side of the chart, the red bars, those are the down years. Over the 98 years of data we have here, there were 26 down years. So that's roughly 27% of the time on an annual basis, the S&P 500 has seen a down year or a loss. Most fell in those years that the market was down, most fell less than 11%. Only a few dipped below 22% in a given year. And just 3 times did the market lose more than 33% in a year. Now, if you look to the right side of the chart, these green bars are the up years, and there are far more of them than there are down years. Roughly 75% of the time on an annual basis is the S&P 500 up. Now, most gains clustered between up 11% and up 32%. You even have some years that topped 54%. And this is the point. The market doesn't move in a straight line. It swings, sometimes wildly. But over time, the overall general trend is upward. And that's where investors often stumble. If you expect tidy 8% to 12% returns every year, you will be thrown off course. But if you understand the full range, what's normal and what's rare, you're better prepared to stay invested. But here's the encouraging part. We've had many more up years than down years by nearly a 3-to-1 margin. And the up years tend to be stronger than the down years are deep. So no, the market is rarely average, but it is consistently rewarded those who stick with it, because successful investing isn't about predicting the next 12 months. It's about understanding the possibilities and staying committed through all of them.
Well, thank you very much, Wayne. I'm gonna, stay on call. I'm kind of curious to see some additional information you might have for us later on, but I think Cindy has some interesting information for us as well regarding, the whole notion that the overall market is a discounting machine, and sometimes it's not what the news is today, but it's what the market is anticipating in the future. Any color on this particular chart, Cindy?
So I like this chart because it shows that the market goes up despite bad news. So it goes back 125 years and kind of shows all of the horrible things that have happened since 1900. The only thing I don't see on here is 9/11, but the beat goes on, and while the negative headlines tend to dominate and we hear about them every day, there are also positive things that happen, and the market will continue to go up. And this particular slide highlights the Dow Jones price weighted index. So that is a little different, but the same idea as we've been talking about the S&P 500 and some of the other indexes this evening.
So what you're saying then is you mean, I know we get caught up in today's news, but the whole notion again is that there's a saying in Wall Street, climbing a wall of worry. What does that mean exactly? Can you help explain that to our audience?
So climbing the wall of worry, it means that the market is going to react and then is going to come back. So
interesting, very good. So in terms of the overall market level, how would you say, coming into this current most recent downturn, and again, we're looking at the S&P 500 here, which is just one of many indexes, but is the market cheap? Is it expensive? Does it represent a good buying opportunity now?
well, I think the market is still overvalued. The S&P 500 over time since 1960, its value is 17.9. And right now, the 12-month trailing PE ratio is 25.7, and the current forward is 20.3. So this just goes to show that extreme valuations can persist over a long time, and it can take a catalyst to kind of react and correct, and it will continue. But looking at the S&P, it was down 4.3% for the quarter and then 5.6% for the month of March.
Interesting.
So wanted to talk a little bit about what did well during the month or during the quarter. Charles mentioned that low volatility worked, and the low volatility factor did work pretty well, and it surpassed the S&P 500. Low volatility performed 7.3 in the first quarter. And just looking forward, we hear a ton about the Mag 7. They are not going away, and they are still anticipated to be maybe not as dominant, but they are anticipated to still be a big part of quarterly earnings. And I think what's happening is people are starting to shift more toward the other components, the other 493 components of that S&P 500 index.
Interesting. This is great visuals to give us a sense for how the market has changed over time and valuation levels. I mean, here you have got this big peak, in the PE ratio during the pandemic, and basically because earnings took a dive and the market went down as well, but the earnings bounced back quickly. You know, the challenge that I have, and I'm sure you've pointed out as well, is that when it comes to snapshots of market valuations, they are perhaps very predictive over the long term. So, you know, whether we use a current PE ratio, whether we use a CAPE PE, which looks back at the average earnings of the last 10 years, you know, they identify extremes, but it's tough to use as a short-term timing measure. Perhaps it's better as a use of understanding of whether or not there's a headwind or a tailwind in the market. Probably better as like a longer term, a 5-year or 10-year expectation of market returns going forward. And this is the S&P 500. Have you seen valuation levels being dramatically different for other market segments, say small caps or mid caps?
I think small caps, they seem to be a little bit depressed.
On a relative basis. So
Yeah,
that,
on a relative basis, correct.
does that give
correct.
investors any opportunities? I mean, I guess if you're looking for values in the market,
I
you
think
know,
it does give investors more opportunities because small caps are obviously a little more nimble than some of these larger companies in the S&P 500 index.
yeah. The challenge being, of course, is that when it comes to liquidity, too often,
That is the
unfortunately, you know,
problem, yes.
when the market's going down, the small caps tend to go down harder because there's just less support for them. Any kind of
Right.
small selling pressure tends to magnify their prices down. By the same token, often they bounce back even stronger when the market takes a turn back up.
Right,
So
and
thank you so
they also
much.
have a little more difficulty accessing
That's true. Yeah.
credit or, yeah.
All that. Yeah, that's a good point. Mid caps are in some ways are almost a little sweet spot there.
Yeah.
As far as a little bit of qualities of both. But so thank you so much. So the key point here is that looking at traditional measures of market valuation, large cap stocks remain expensive, but it's difficult to do any kind of short-term timing off that. It's really more of an indication of longer term expectations. Any other points you want to bring up before we move on to the next section?
I would say that a lot of people might be scratching their head and saying, okay, 1960, that's a long, long time ago. And I certainly wasn't in the market then. I might not even have been born at that point in time, but you can also break this down and look at, you know, like 5-year, 10-year periods, or go back to 1990, or we've talked about the tech wreck and the dot-com bubble. You could go back to then and take a look at these valuations as well and find the same story.
Yeah, it's also it's a good point you bring up. It's also I find it even helpful to look at it at either by decile, by decades in terms of years, but even typical bull market, bear market levels. What's the extreme at either level? So it's and we have charts of that available for our members online.
We do. Yes.
Thank you. Well, you
Thank
know, I
you.
think it's you know, we've obviously been talking a little bit about what the market has been. I guess moving into the next section really is what can we do now as investors? And I'm going to bring back Charles here because, you know, one of, I think when you have a market environment like this, I think it always reminds us kind of as a, you know, it's a good gut check as far as what we thought we could do as far as risk versus what we really could actually tolerate. Charles, any particular points on this particular slide here for us?
Yeah, I'll get into it, but since you talked about risk, I want to start with that. It's important to realize that your sense of risk, your sense of risk tolerance varies by the day. There's even been studies that shown if you to meet with an advisor, they give you a risk questionnaire trying to assess your risk level, what the weather is outside or how traffic was when you drove over to the office, that's going to affect your tolerance of risk. Our brains are said to be noisy, which is a term behavioral scientists use, meaning that it gets affected by a lot of different things that don't necessarily have to do with anything with the subject at hand. But I do like to say that market corrections, down markets, are probably the ideal time to assess your risk tolerance, because your true test of how much risk you can tolerate is how you react when the markets are down and when the markets are turbulent. That's a true test, because when everything's great, it's easy to say, yes, I can tolerate downside risk. But when things are uncertain and things are dropping, that's when you really get a sense of how much you can actually withstand in terms of volatility. So going back to this, that was a bit of a long introduction. This is from our PRISM wealth building process. And the idea about PRISM is simply to match your investing plan with your goals. So if your goals are long-term, your approach to investing should be long-term. If your goals are short-term, then you ought to think about short-term investments, say like money market funds or CDs. It really comes down to, when do you need the money? How much money do you need to withdraw out of what your portfolio has? And what the time period is you need over those withdrawals. And for many people listening, you probably have more than one goal, but what PRISM tries to do is try to match your strategy with your goal. And the one thing I want to focus here is really on the bottom part where I have it in an oval, which is our ability to tolerate risk, because that applies to our current situation. And there's different ways of assessing risk. What we did here at AAII was really kind of think about what are the key factors that drive risk. And one of the things on there is simply, if the market drops, will that affect your goal? So say you're looking at, say you're retired, market drops, is that going to affect your ability to take withdrawals? Is it going to affect your ability to have care? If you tend to be affluent and you have a lot of money, or say perhaps you have Social Security income, pension income that's covering your daily expenses, then a market drop's probably not likely to prevent you from funding retirement throughout retirement for how many years you have left. And hopefully, if you're retired, it's many years of quality life. However, say your goal is you want to buy a house in the next 2 years and you have all your money in the stock market, then yes, that would actually affect your ability perhaps to put a down payment on the house you would want. We also asked from a psychological standpoint, will it cause you to pull out of stocks? And this is where the psychological component comes in. If you're feeling at an ease, you've pulled money out, or you're really tempted to pull money out, that might be a sign that perhaps your allocation has been too aggressive. Whenever I speak in person, I always like to say the optimal allocation is the one you could stick with no matter what the market is doing. And an allocation that might be a little more conservative, if you go back to Wayne's table, perhaps you get a little less return than some of the numbers he showed. That return may still be higher than a return where that involves you trying to, an allocation that involves you trying to maximize your return, but you can't handle the volatility that's associated with that. So you always need to take in consideration, when the market goes down, what's your ability to sleep soundly at night, and knowing that's a temporary event versus your emotions going, I'm going to lose money over this. I can't stand this volatility. I need to cut out of stocks. And the other component is basically, when do you need withdrawals? If you need a small amount of withdrawals relative to your wealth, then down markets aren't a big threat. But like I said, if you need, like going back to the example of buying a house, if you need to take a large portion out of your savings over a short period of time, then you really need to think about not being involved in stocks, but really dialing down your risk in terms of volatility and going with safer assets, even though they have a lower return. If you're short-term horizon, you need to protect that capital. And finally, think about long-term inflation. And that's one of the things, whenever there's a pullback or there's a correction or a bear market, you never hear people going on TV or on CNBC or on Barron's saying that if your goal is 40 years in the future, what's happening right now is not your risk. Your risk is not staying allocated to stocks to really get that growth that Wayne just showed you, to have your portfolio grow for the long term. And so for PRISM, we're trying to get people to think in terms of those mindsets and those factors, and then base your allocation on what's the time frame of your goal and what is your ability to withstand risk, and what is the real risk. Is it short-term volatility, or is it long-term inflation? Two very different things.
I remember Jim. What did Jim Clunan call phantom risk and real risk? Do you recall?
I do. He called phantom risk the daily moves of the market, and real risk was not having the money you need at the time you need it.
So the key is to have the money when you need it. Now you've been tossing out a term here a couple of times, PRISM. Is that an acronym? What does that stand for?
It is. It's actually, it ties into your goals, and it's basically, it's prioritizing your goals. It's recognizing your tolerance and your allocation. It's identifying your preferences. What are you, a value investor? Are you a growth investor? Do you want to self-manage? Do you want to use funds on it? When you get to the S, it's selecting your investments. And we put S after everything else because it really is, what are your goals? What's your risk tolerance? How do you want to invest? And if you really want to invest in ETFs, then looking at stocks doesn't make sense because you're an ETF investor. And finally, the M is simply monitoring your goals, monitoring your progress towards your goals, but also monitoring your life stage. Has something happened, say you've gone from working to retirement, or maybe you've been blessed with a new child or a new grandchild, and how does that affect your goals and what you want to do?
Thank you. And just as I've seen this question pop up a couple times online. When we send out anybody who signed up for this webinar, we're going to send out a email. It's going to list resources. We will include resources to the overall PRISM process, as well as the specific one-page plan for maximizing your long-term wealth. So that's just a reminder, anybody who's listening in today. And this is being recorded. It'll be available on our YouTube channel as well. So thank you so much. So Charles, you talked a little bit about emotional biases. Is that what we kind of get into our next slide here?
Yeah, absolutely. And I think one thing to realize is that our brains are not hardwired to deal with the markets. If you think about the history of mankind, our ancestors were really worried about what was rustling in the savannah. They were worried about day-to-day living. And our brains actually evolved to be highly reactive. And, if you're, John, I know you're a big fan of Survivor, and if you're out there and, they stick in some really bad environments, that skill works really well. But if your skill's trying to deal with the day-to-day headlines, being reactive doesn't work in your favor. And some of the things that can really trigger you, one is media consumption. We're day-to-day news flow. We all have our phones. They're sending off alerts to us. We turn on the media, we turn on the internet, there's headlines, watch TV, there's headlines. We get bombarded with information, and the ability to turn off that information, or at least filter it, and realize that, is it noise or is it really pertinent to my long-term goals? Being able to make that separation is a big thing, and it's not easy because our brains are not programmed to do that.
What do you recommend, Charles? So how does an investor, we've gone to a world now where, it used to be, when I got started in this industry, perhaps you as well, there weren't that many sources for news. If you wanted to get information on a company's annual report, you actually had to, call them and they mail it to you, or go to the local library. So how today, how does an investor actually kind of filter out this constant barrage of information?
Well, I think one of the things in there is realize you don't have to know what's going on every day. You're talking about the markets. I'm a former Washington Post carrier, so I remember delivering the newspapers where people got their news in the morning, or maybe they caught the 10 o'clock news, and after 10 o'clock news, you had some shows, you had the Star Spangled Banner, and that was it for the TV station. But now I think people realize you don't have to look at the news as much as you think you do. I look at the news first thing in the morning. I might check midday to see what the markets are doing. But John, you manage a shadow stock portfolio. We provide updates monthly, portfolio review once per quarter. And so if you're holding long-term investments, you do not need to follow them every day. You could actually look on a Saturday, what news came out this week, to react to it. If you tend to be a news junkie, what I would suggest is set bears on how often you'll look. Perhaps you look just once in the morning, or maybe you look once in the morning, once at night, when the market's closed, so you don't react on that. You have some time to chill down. And I think that's one of the good things, is just setting consumption limits on how much news you absorb, because the reality is knowing everything up to date really isn't going to make a big difference in your portfolio management, particularly if your goals are long-term.
So I guess it depends, matching up that news cycle or the analysis cycle to the style of investing. So if you're a momentum investor or a growth investor, you may need that continuous hit of information. Whereas if you're a long-term value investor, obviously you want to avoid a value trap, but you probably need to almost take a step back. And in the case of the micro cap shadow stocks, where there's a high cost because of liquidity of moving in and out of the market, you don't want to overreact to non-meaningful information. Is that kind of the point there?
Yeah, absolutely. And realize that even if you use technical analysis, there's trading strategies that are based on, say, a week or a month. And if you're following one of those more swing trading type things, again, you do not need up-to-date information on your data. You want to obviously stay involved with your investments closer, but again, you don't need to be glued to CNBC or your favorite news feed every moment of the day.
So I've got a question here on your last bullet point here. So do you give Marnie, your wife, full information on the ups and downs of your portfolio on a daily basis?
I do not. I do not.
Well, tell me a little bit about the last behavioral bias here.
Yeah, well, and so I think we humans tend to hate low losses. That's just bred into our behavior. And there's something called prospect theory that basically says there's a trade-off that people want $2 for every perceived loss versus $1 for every perceived gain. So they actually place a bigger dollar value on losses than they do on gains. And the reason for that is we feel the pain of losses more than we feel the pleasure from gains. And what happens is when we have losses, we actually tend to become risk-seeking, which means if we lose $10, we're willing to lose $10 more. So it means there's a small chance that we get to break even though there's a great chance that we'll lose more money. And so what happens is we tend to actually become more irrational the more we lose money, simply because we have such a desire to avoid losses. And particularly, we really become very narrow in terms of our vision. We focus on the losses versus realizing perhaps maybe we've made 500% of our investments. Well, all of a sudden we're down 20%. We completely forget the fact that, hey, I'm still up 480% of my investments.
Yeah, I think there's a tendency to people to tend to take their profits too quickly, and they tend to hold on to their losses too long. That seems to be the common thing to fight.
Yes. And a very hard thing to fight, because whatever we own, we tend to place greater value on that than the things we don't own.
And in some ways, that's why I think, you get into technical analysis. In some ways, that's almost your support and resistance. In some cases, is almost on an individual stock basis or even market basis is tied toward those points where a lot of people got in or out of the market. So sometimes you have to get past those psychological barriers to actually break through those resistance points.
Absolutely. It's important to realize that even if you're using technical analysis, these psychological barriers don't go away. And the key to technical analysis is to act on those signals. And if your emotions interfere, you're not going to act on those signals, and you'll actually be worse off than if you're just a buy and hold investor.
So thank you so much. One of the things I know that we've developed over time is to help our members is to kind of come up with some model allocations. And depending upon, if you could take the risk profile in the PRISM system, you could take a look at your tolerance for risk, or whether or not you're emphasizing safety. And I think risk is a function of both time horizon, how much money you have, how quickly you need the money. But we have, I guess, provided some model asset allocations that help encompass a range of typical asset allocations, and they also even include the potential for a loss in a given year. Cindy, any particular points you want to highlight here in this chart?
Well, I think these are really good because they offer a disciplined process. And one way to manage your risk is to look at your asset allocation and have a plan in advance for what will cause you to rebalance. So, I mean, if we knew that a particular asset was going to go up, then you go ahead and own that one asset, but we don't know that. So these provide that opportunity to kind of customize and meet your personal needs. And one thing that we've done with these, if you are a reader of our journal, you may have ran into these articles already. We've come up with a series of ETFs and mutual funds that can be used to fill your asset allocation needs. So one thing I did want to show on these charts is we have the characteristics, and so we're showing how much this will go down in a bad year.
That's based upon what the percentage of allocation and the typical worst case scenario we've observed for these asset classes. So if you're an aggressive investor, this may provide you the best opportunity for long-term gains, but you have to be willing to withhold, potentially a 40% drop in a bad year, because most of your money is actually allocated towards stocks and very little is allocated towards fixed income. So obviously, it's ahead of the time. It's always easy to say I could handle that kind of volatility. Obviously, the test is when you're encountering that kind of volatility. Because I mean, the worst thing we could do as investors is really sell at a bottom. And I think when sell when it doesn't make sense to sell. And all of a sudden you're missing out on the opportunity for that market to bounce back, as we saw. As long term, in the market has always bounced back from its bear market situations. Any other thoughts you want to provide here on this chart?
I would say that as you kind of move across the spectrum, aggressive down to conservative, your loss obviously gets smaller. So just some very helpful information. And then we have the resource, the web link at the bottom, which you will receive in the handouts. And I wanted to go back to something that Charles said. He reminded me of a book, one of the first books that I read on behavioral finance, and it is called Mean Markets, Lizard Brains. So it's kind of an interesting book to read.
So we'll be sure to include that in our resources for people. What's your best takeaway from that book, Cindy?
Well, I think it just taught you how you're going to think when you panic or when you start losing.
Gotcha. Thank you so much. Are there any technical things that people can do? And I mean, downturns are never good, but I mean, one of the things you have highlighted here is the whole tax loss harvesting. What exactly is that, and why would you want to do that as an investor?
So tax loss harvesting is really you're going to sell your positions with a paper loss, so then you can use that paper loss to offset gains. And so that's $3,000 for individual investors, or $1,500 if you're a married person filing separately. And then you can take those losses and carry them over infinitely, as long as they last, into future years. And you're going to use that in conjunction with the wash sale rules to prevent the loss. You can't claim a loss if you buy the same asset or purchase it like 30 days before or 30 days after. And then going back to our 2024 tax guide, this has a lot of really helpful information on how to do this. This is easier to do with mutual funds and ETFs that are similar. And this is not something that you will do in your traditional IRA or 401k account or tax deferred accounts, but you wouldn't do that in your Roth account either, since Roth contributions are made on an after tax basis. But how this will work is the capital losses first reduce the capital gains. Long-term losses reduce the long-term gains first, and then the short-term losses are going to reduce the short-term gains first, and then any long-term losses left over reduce short-term gains, and vice versa. So it's a little bit, probably sounds a little confusing, but we do have resources that we will include in our handout, and then you can reduce your ordinary income by $3,000.
In addition to any kind of losses, you're actually be able to take it against. It's a great point to keep in mind. I know that tax day is coming up tomorrow, but Cindy and I were chatting earlier about this, and I ended up harvesting some losses on some funds a couple of years ago. I was actually able to offset it against some income this year, so it was I was carrying it forward for a couple of years, but it helped reduce my taxable income for the year since I had some distributions made from my mutual fund holdings last year. So it's a great chance to reduce your taxable income in your taxable accounts.
And I hope all of you are very far along or done with your taxes. Knowing that you have to go grapple with that after this webinar does not make me feel happy.
Anything, some points here as far as any kind of retirement account tax opportunities when it comes to downturns?
So I'm the lead editor for retirement investing, and I'm really passionate about retirement account tax opportunities. And I would just say that if you are still making contributions to your employer account or to your IRA, you might want to just look at investing these, even if you're investing in something conservative instead of stuffing it away in cash. I think cash is an important component also, and it can help offset a lot of risk, but that's it's a good thing to keep everything invested. Like John said, you know, you don't want to sell at the bottom of the market either. And avoid taking loans or distributions from your plans. I know all of you are way smarter than to consider doing that, but just a reminder, in-kind distributions. So this is something that I really like, because if you are taking an RMD, it will allow you to transfer your shares over to a taxable account, and then you can still have exposure to those investments, let them recover, and you can potentially lower your taxes owed when the asset is eventually sold. And then Roth conversions, those can create tax savings opportunities. You're going to get lower taxable income from the conversion because you're going to have a lower balance to start with in a down market. And then again, you'll get the growth opportunity when the market recovers. And Roths do not have RMDs. That went away. So those are good things to consider. So back to the in-kind distributions just for a moment. After you move those over to your taxable account, you're going to get a new cost basis, the fair market value on the transfer date. So then if you believe those assets are going to go up, and they do, and you sell them, then you're going to pay taxes, capital gains, on the difference, as opposed to if you held those over in your IRA and you later sold them, you're going to be taxed at ordinary income rates. Since this is an RMD strategy, you're still going to owe taxes on your RMD, unfortunately, but this is just something to keep in mind.
Thank you. You know, obviously, as editor of the retirement investing newsletter, you know, one of the key components I think you've covered over the years is the level 3 cash allocation strategy that Jim put together, and that it's an interesting approach. It kind of gives you some guidance in a given year if you should be in effect selling stocks or living off cash. Want to give us a little bit of information on that?
Oh, sure. So the level 3 incorporates growth and defensive assets, and then investors maintain that high allocation to growth equities to kind of surpass inflation. And then you're at the same time building a defensive position allocated 4 years before retirement. So that is kind of the main idea, and it allows you to handle market downturns early in retirement. I know that's something a lot of people are terrified of, is, you know, what's going to happen if I retire in a bad market year, and I don't have any choice over it. I can't continue to work for whatever reason. So this will help you ensure stable income and liquidity for planned expenses over the meantime, while allowing those long-term assets to recover from that market volatility. And one
Yeah,
of the
I'm
beautiful
sorry.
things, oh, go ahead, please.
No, go ahead, please.
Oh, I was going to say, one of the beautiful things about it is each year you decide if is the market 5% below the previous all-time high, and does that cause you to switch into defensive mode? Or can you go ahead and allocate or take a withdrawal from the safe portion of your portfolio until the market is within that high, or are you going to take a withdrawal from the equity part of your portfolio?
And the next slide shows an example, but I guess I wanted to highlight here that what we did, I think, in testing out the strategy is that we found that typically speaking, if you could build up a cash reserve of 4 years of your spending, and at least historically, that was enough to cover all the different market extremes. So the idea is ahead of retirement, ahead of when you need to withdraw money out of your portfolio, you build up a 4-year cushion of your expected outcome, money you're going to be living off of. And then at the beginning of the year, again, we chose to make it as simple as possible, or Jim did, because a simple procedure is more likely to be followed than a very complex procedure. So a simple test is, for the upcoming year, am I going to live off my cash savings? Or am I going to live off my stock portfolio? The notion here is I'm going to be selling off my stock portfolio position when it's near a high. I'm going to be, in effect, using living off my cash position when the market's down from its high. And this is an example, Cindy, of the process over time.
Yes, it's an example of the process over time. It would start on January 1 of 2030, but this, you could use this to apply to any time frame.
And do you update this in both the journal and retirement investing periodically?
Yes, this particular example is from retirement investing, but examples of the level 3 cash allocation strategy can be found in the journal also.
Very good. And we'll provide
Yeah.
resources to that in the email
Yes.
follow-up to this. Thank you. Also,
Yes,
I noticed you put
it's a
this.
very intuitive strategy.
Yeah, it's. I think it's a great way to think about the timing risk, or the sequence of risk that people definitely suffer with, and it's a way to kind of circumvent that. And notice you
And I
put a
would
bucket
say
strategy
that-
here. I'm sorry.
Oh, I would say that the 4-year time frame is maybe a little more conservative than what you typically hear with the 2-year time
Mhm.
frame, having enough cash for 2 years. So that provides investors just an extra level of comfort, in my opinion.
Little peace of mind. It's always
Yes,
always
peace of
good.
mind. And a lot of our subscribers also use the bucket strategy concurrently with the level 3 strategy. And
Just a quick rundown. What is the bucket strategy?
so the bucket strategy is Christine Benz over at Morningstar. A lot of our subscribers follow her as well, but you're going to have 3 buckets. The first one is going to have all of your cash and cash equivalents, and is going to fund your shorter term living expenses, kind of what you're talking about, John, we're talking about the level 3 strategy. And then the second bucket is going to be more the intermediate term assets, and the third bucket, that's going to have your longer term riskier assets. And the idea is to kind of backfill and keep filling that first bucket so that you don't have to tap into that third bucket, rebalance the buckets every year. But this strategy really doesn't say that you can't tap that third bucket if you need to.
And I guess we haven't really touched upon this, but you brought up a good point now. So whenever you have an asset allocation that you pick out, whatever it is, if it's the ones we talked previously about the aggressive, or it's probably helpful to periodically actually adjust your allocation to make sure you are within plus or minus your allocation. Otherwise, you create an allocation, and when stocks do well, all of a sudden they tend to dominate your portfolio, and then all of a sudden you're out of balance. So it's important that if you have an allocation, that you set up a schedule or a process or technique in advance to actually rebalance. Do you have any tips? What do you do normally? Do you tend to do as a percentage of within your bands? Do you do it periodically?
I do it periodically. I do it at the beginning of the year, and I do it mid-year, and I have a band. I think maybe in these market crisis situations, it's a good opportunity, depending on what your goals are, to take a closer look, even though you're going a little bit out of cycle, and just make sure that you haven't deviated from those allocations too much, or like we were talking about, the different risk tolerance and different time frames for needing your money, just maybe trying to de-risk your portfolio a
Sure.
little bit if you're that worried about it, or search for opportunities like Charles talked about, buying something if it's declined 20%. That's a great opportunity for
And
certain
if
types of assets.
your ability to rebalance your portfolio, that your strategy could vary if you're in a asset accumulation phase, or if you're in a withdrawal phase. If you're in asset accumulation phase, you could put new money to work in the underweighted parts of your portfolio. Whereas if you're in a withdrawal phase, you would typically, I guess, try to sell off or reduce the over weighted segments of your portfolio. So it's almost a way of kind of balancing out kind of your selling high, buying low mentality. Well, thank you so much, Cindy. We're going to touch a little bit about some of the tools that you as members have access to on our website. I think in this context, I think Wayne is going to give us a little bit of information here.
Yes, moving right along. So as an AAII member, you have access to tools designed to keep you grounded, calm, clear, and confident, even when the headlines are loud. Let's start with idea generation. We offer powerful stock, ETF, and mutual fund screeners. They help you cut through the noise and uncover investments that fit your strategy. We also have evaluators, whether it's funds, ETFs, or individual stocks. You can take a deep dive into company fundamentals. We have our A+ stock grades that pull together quality, value, growth, estimate revisions, and momentum. So you can take a big picture at a glance of an individual company. We also have our model portfolios, each with a clear evidence-based strategy. We have the shadow stock portfolio for undervalued microcaps. We also have our premium portfolios, dividend investing, growth investing, the SOX Superstars report, and VMQ stocks, each one built on evidence-based discipline, not guesswork. We also offer retirement-focused tools through AAII Retirement Investing, plus portfolio tracking and analysis, so you always know where you stand. Now, we could spend all day going through all of these, but for today, I pulled together just a few of the key highlights to help you, again, keep grounded when the market starts getting volatile. The real value in these tools isn't the tools themselves. It's what they help you do, and that helps you to stay steady, stay informed, and stay invested, no matter what the market throws at you. So here on slide number 24, I'm going to introduce you to one of our most practical hands-on tools AI offers for today's ETF investor, and that's our redesigned ETF screener. This is a powerful member-only resource built for people who want to get more than just generic ETF lists. It's for investors who want to filter based on what actually matters to them. In this slide here, we have an example of it in action using real criteria. Across the top, you can see the filters that I applied for this particular example. I screened for US equity ETFs, focusing on large blend, large value, mid cap value, and small cap value, each of which are core building blocks for a diversified portfolio. Then I limited risk rank to the lowest 25%, so I'm only looking for funds with historically lower volatility. I also added a yield filter for over 2% and then targeted expense ratios in the lowest quartile. So after starting with thousands of ETFs in our universe and applying all of these filters, that left me with just 5 ETFs passing the screen. And that's exactly the point. The goal isn't to see everything. It's to surface the best fits for your strategy. And here you'll find names like the iShares Focused Value Factor ETF, Vanguard's US Value Factor ETF, as well as Invesco's S&P 500 Enhanced Value ETF. And if you want to take this data offline, with one click, you can export data into Excel. But really what makes this screener so valuable is how specific you can be with it. You can look at asset type, risk, yield, fees, it's all here. So as the ETF universe grows to the thousands, this tool helps you cut through the noise. And if you are an ETF investor and haven't tried this tool out, it could very well become your new favorite member benefit. Now, looking at slide number 25, when you're choosing between ETFs, this can be overwhelming. You have ETFs with similar names, overlapping strategies, endless performance data, etc. And that's exactly why we built the AAII ETF comparison tool, to help you cut through the noise and make smarter decisions faster. Now, what you see here is an actual comparison of 3 dividend-focused ETFs. I took the Franklin US Low Volatility High Dividend ETF, the Invesco S&P 500 High Dividend Low Volatility ETF, and the Vanguard Dividend Appreciation ETF. Now, each fund has a unique strategy, but this tool helps to put them side by side so you can see exactly what sets them apart. You get clarity on category, large blend or large value, plus inception dates and whether they're index-based, which all 3 of these are. Then it gets visual. You get performance metrics are graded, 1 month, 3 month, year to date, and 5-year returns are all color-coded with letter grades so you can spot strengths at a glance. Now, LVHD and SPHD shine in the 1-year column, and they each receive A-grade returns of at least 16%. But over 5 years, VAG leads with a 15.6% annualized return despite softer recent performance. So this tool helps you avoid recency bias and focus on what really matters: long-term consistency over short-term sizzle. And it's not just about performance when you're looking at these different funds. You can compare risk and cost as well, category-specific volatility, total risk indexes, turnover rates, and expense ratios. Now take, for example, VIG. It has an expense ratio of just 0.5%. Now that's ultra-low classic Vanguard. LVHD and SPHD charge more, but offer income-driven, low volatility strategies that some investors may value. But here's the bottom line. Picking the right ETF isn't necessarily about chasing returns. It's about aligning a fund's strategy, risk, and cost with your own goals. This tool doesn't just compare tickers, it empowers better decisions. So moving on to slide number 26, when the market turns chaotic, headlines are flashing red, fears taking the wheel, most investors retreat, which is natural instinct. But seasoned investors, well, they lean into it because in every storm, opportunity whispers. Now, this slide outlines traits that help identify resilient long-term stock opportunities, especially when the world feels upside down. First off, you look for financial strength. You're looking for solid balance sheets, low debt, high liquidity, manageable refinancing, because when the economy tightens, cash becomes king. Strong companies don't just survive downturns, they often emerge stronger. Secondly is consistent free cash flow. Now, this isn't just a number, this is flexibility. Cash flow lets companies reinvest, pay dividends, and buy back shares, or simply ride out the storm without scrambling for capital. We can also look for operational agility and pricing power. Can the company pivot when supply chains are strained? Can it adapt if tariffs hit or commodities spike? Or do they have pricing power? If they do, that's golden. It protects margins, signals strength, and keeps earnings intact even when inflation starts taking a bite. You can also look for domestic revenue focus. US-centric companies avoid turbulence of currency risk, geopolitical swings, and global trade disruptions. Now, you don't need to be insulated from the world, but they are more stable when the world starts to shake. Right now, you could also be looking for defensive sectors. These could include utilities, healthcare, and consumer staples. No matter what's going on in the world, people still need to turn the lights on. They're going to be taking their medications, and no matter what the cost is, they still have to buy some level of groceries, recession or not. There's also policy alignment. Companies positioned to benefit from national priorities, energy, infrastructure, defense, often ride powerful tailwinds. And in some cases, regulation becomes a moat, not a hurdle. So you might want to look for companies that could be benefiting from any changes in regulatory policy. And then finally, valuation discipline. We don't want to overpay for safety. Just because it feels secure doesn't mean it's fairly priced. And you want to look for companies trading below their norms, not just below their peers, because chaos doesn't have to mean crisis. If you focus on cash flow, pricing power, and strategic clarity, you're not just weathering the storm, you're positioning the lead when the skies are clear. So now we move on to slide.
So
Go ahead. Sorry.
I noticed that you have a mix here of some things are sort of quantitative in nature or some are qualitative. So I guess as an investor, it's important to kind of keep both in mind. Is that what you're saying? So perhaps develop some qualitative measures of companies, and then you have to apply some judgment. Is that sort of the whole bottom line there?
Yes, and in some cases you can find fundamental proxies for more qualitative elements as well. So pricing power, that's difficult to screen on, but that often shows up in margins. Same thing for market leaders with competitive moats. One proxy we often use when building screens is if you look at trends in margins over time, and if a company is consistently have margins that are significantly above their industry peers, this often points to some type of competitive advantage.
Thank you.
So when the market feels uncertain or downright chaotic, it's natural to get defensive. But getting defensive doesn't mean hiding in cash. It means being selective, strategic, and data-driven. And that's really where AAII's stock idea screens come into play. We currently track roughly 50 screening methodologies, each rooted in time-tested investment principles. And if you use our power ranking tool, we highlight the ones that stood out during the most recent bear market. Now, these aren't just random filters that we use for these different screen ideas. They're grounded in the philosophies of investing legends, Jim O'Shaughnessy, Peter Lynch, Philip Fisher, adapted and rigorously tested with decades of AAII data. Now, in this case, we're looking for AAII stock idea screens that perform best over the most recent bear market period. And we can see that by looking at the bear market price gain column. That shows how each screen performed during the last market downturn. Now at the top, we have O'Shaughnessy's Tiny Titans. This particular screen focuses on small cap stocks, which, although typically more volatile, posted just a 1.9% loss during the last bear market. Now, why is that? Well, it blends value, size, and momentum to find small rising companies with strong fundamentals. We also have the Lynch screen, which is inspired by Buy What You Know. This favors steady, undervalued growth companies, and it held up with just a 2.7% loss over the last bear market. We can also see that the Fisher screen fell 3.4% in the last bear market. And then we revisit Jim O'Shaughnessy with his growth screen number 2 that fell 3.7% in the last bear market. Now, these screens aren't static. They're updated daily on AAI.com. You can explore the passing companies, dive into the criteria, and apply them to your strategy. Now, the point here isn't to blindly follow a screen. It's to anchor your decision making, especially when emotions are running high. Because when the headlines scream and the market shake, these frameworks help you stay grounded and focus on what endures. Strong balance sheets, steady earnings, reasonable valuations, and resilience. That's how you stay defensive without running scared.
Thank you.
Now, the next slide, when markets start getting choppy, whether that's because of inflation, geopolitics, or investor fear, we all start asking the same question typically: where can I find stability? Now, this slide highlights one of the most powerful and often underappreciated tools in that search, and that's low volatility stocks ranked by AAII's risk index. Now, each screen here has a track record of surfacing companies with lower price volatility, an essential trait when uncertainty runs high. Now, what defines low volatility? It's all about the risk index. And this measures how volatile an individual screen is relative to the S&P 500. A score of 1 means that the screen matches the market's volatility. So a screen of a 1.03 risk index, that means it's roughly 3% more volatile than the S&P 500, which is remarkably stable. So again, we see here the top 4 AAI stock idea screens based on the risk index from the lowest to the highest. So first off, we have Graham's Defensive Investor Utility Screen. This is rooted in Ben Graham's principles that focuses on value, financial strength, and stability, especially in utility stocks. The risk index is 1.03, and it's built for resilience. We also have the Dividend High Relative Yield Screen. Now, this particular idea screen looks for income generating stocks with stronger yields than their peers, especially attractive in volatile markets. And it has a risk index of 1.08. And then looking at the number 3 screen on this, it's Value on the Move, the peg with historical growth. And this personally is actually one of my more favorite screens. And this one blends value, momentum, and historical earnings growth. So it's sort of a different look at value on the move, or a growth at a reasonable price. Even with a growth tilt, the risk index is just 1.11. And this offers proof that you can pursue smart growth without excessive risk. So again, you have the ability here using the power ranking to screen rank over a number of different elements, different performance performance over varying time periods, risk index, bear and bull market performance, etc. So that's a quick overview of some of the elements of our stock screens. So now we're going to look at slide number 29. And this is going to just, again, this was a very quick overview of some of the tools that AI provides. And want to highlight what I consider to be one of our most powerful and intuitive tools that AI offers, and that's our A+ stock grade screener. If you're looking to cut through the noise, evaluate a stock from multiple angles, but still stay grounded in fundamentals, the A+ stock grades and the A+ stock grade screener is really where you can start. What you're seeing here is a live snapshot of the S&P 500 healthcare sector as of April 9th, 2025. Across the top, you see the 5 core investment factors that make up the A+ stock grades: value, growth, momentum, estimate revisions, and quality. And for each factor, the screener shows how many stocks earned each grade from A to F. Now, using the sliders, you can tighten or loosen the filters. So you can look, for example, value grades of A or B, momentum grades of D or higher. So, whether you want to cast a wide net or hone in on only a few top tier names, you're in control as far as identifying what matters to you. But here's the real power here is every stock gets both a numerical score and a letter grade for each factor. So instead of looking at just a singular data point like the PE ratio, you get a full diagnostic, a health check across multiple financial vital signs. You can also look for example, stocks that are undervalued but showing upward earnings revisions. Is a stock gaining momentum and backed by strong balance sheet quality? This particular tool gives you a clear multi-dimensional view very quickly. And it's not just for screening, it's for decision making, rooted in disciplined, backed data. And then lastly tonight, slide number 30, I want to talk about one of the simplest but most powerful tools you can use to navigate a downturn like a pro. And that's the strategic buy list. At the top of this slide, you see what many consider to be Warren Buffett's most famous lines. Be fearful when others are greedy, and greedy when others are fearful. But let's be honest, when the markets are plunging, fear is very loud and it's very prevalent. The only way to act rationally in these moments is to have a plan prepared before the panic begins. And if there's one thing that I've taken away from my 28 years at AAII is invest with a plan. have a clear-cut methodology for selecting stocks. Now, I'm a stock guy, so that's where my frame of reference. But even on the sell side, I've managed the SSR portfolio. I created and managed the growth investing portfolio. Every model portfolio that AAI has very clearly defined rules of when you buy a stock, but perhaps even more importantly, it has very clear-cut rules on when it's time to move on. And that's the key here, is you need to have that plan. But you want to have this plan because you want to be able to act rationally in those moments when the panic begins. And that's what this buy list gives you. It's a calm voice of reason written in advance. It's ready to guide your actions when the headlines start screaming. So, why are buy lists essential? Well, first off, they protect you from emotional decisions. You're anchored in fundamentals, not adrenaline. Secondly, they let you move with confidence. When a quality stock hits your price target, there's no second guessing. You're ready to act. Thirdly, they keep you focused on long-term value because markets move fast, but your horizon is often measured in years. So the best time to build a buy list, it's before the storm. Use your fundamental analysis, choose companies you believe in, and then set entry points, 10%, 20, maybe 30% below intrinsic value. Then when volatility hits, you're not scrambling, you're shopping. Corrections feel uncomfortable, but there are also opportunities in disguise. Some of the strongest portfolios weren't built in bull markets. They were built because of how investors behaved in bear markets. So as we close tonight, I want to leave you with this, and I've said this multiple times tonight, but I think it's bear repeating. Stay disciplined, stay invested, and stay focused, because a downturn isn't just the end of your plan. It might just be the beginning of your next great opportunity.
Thank you so much, Wayne. And I know that we've been running a little bit long here, a little bit longer than anticipated, but we're here to answer your questions as much as we can. And with that, I'm going to start. Let's bring all the analysts back online. I'll pop to the questions slide here. But I guess Charles or Cindy, for watch sales rules, what do you mean by similar assets? Can you give an example?
So do you want me to take it or do you want to take it?
I'll take it, of course.
Sure.
So a similar asset would be if you have an ETF that tracks the S&P 500, then another ETF that tracks the S&P 500, or a mutual fund that tracks the S&P 500 index-based. That's one example.
You could in fact buy you could sell iShares and buy a Spider, and it'd be in effect they're
Right.
considered dissimilar enough. It doesn't really, the IRS would not consider that a wash sale, even though in effect the IRS is essentially the same investment.
Yeah, what you don't want to do is say sell Nike and then buy options on Nike. That's considered substantially the same. But you can sell Nike and say buy shares of Adidas or On or another shoe company. Just don't buy any Nike options or a single stock ETF that perhaps you sell Tesla. You don't want to turn on buy a single stock ETF that's based on Tesla stock.
Thank you. And when it comes to wash sales rules, we're talking about, I'm sorry, strike that. When it comes to tax loss harvesting, we are talking about taxable accounts, not tax deferred accounts. That's an important consideration.
Yes.
Someone just wanted a clarification on.
Yes, I realized I covered a lot. I thought I had talked about that a little bit, but yes, that's correct.
No worries. No, it's just a clarification on that. When it comes to, this is again, pull out your crystal balls. Will anybody think that high tariffs will affect large caps or small caps more? I know typically small cap companies are more domestically focused, but tariffs are a challenge because many inputs are used for both. But anybody want to tackle that question?
Well, I think it depends on how you look at it. When you can look at tariffs and how they impact individual companies, but then you can also look at the way that tariffs are being handled right now and the volatility that that's putting into the marketplace. So tariffs could definitely be impacting companies individually. But I think, right now anyway, until we get a truly clear picture on what the tariff policy is going to be, it's the volatility that the discussion of tariffs is having on the overall market. And from that standpoint, as I think John alluded to earlier, is smaller companies tend to react more negatively relative to the market, or respond in a greater magnitude to the overall market. So to the downside, when there's volatility to the downside, smaller companies are going to fall more drastically. But then on to the upside, when the stock market goes up, smaller companies will tend to outperform as well. So I think right now, until we get a better clarity of what actual tariff policy it's going to be, it's more so, at least in my mind, it's the impact that the discussion of tariffs is going to have on volatility in the marketplace.
Thank you. I'm not sure how to summarize this, but I've seen a lot of questions here point to the situation that we seem to have an administration that is moving very quickly and hasn't necessarily laid out its plan very carefully as far as tariffs are. I mean, we could all agree, I think, that a number of countries have taken advantage of our situation and have an imbalance when it comes to tariffs and whatnot. But is there a strategy to try to raise money from tariffs to try to get taxes? It seems to be at times, on again, off again. How does an investor act? And I think we're probably in a 4-year cycle of a lot of noise in the market. How does an investor act in that kind of environment? What are the best tips that any of you could provide for a situation where it is difficult to understand clearly what the long-term objective or strategy might be?
I think sometimes you have to embrace the known unknowns. This is one of those situations. I mean, Wayne was talking about small company stocks, but even if you find a company that does business domestically, as Wayne alluded to, you don't know where supply chain is. And I think now when you're dealing with tariffs, you're dealing with a micro policy that is very uncertain. And it's far reaching. So I think you really have to think about what's your time frame. Your time frame's long term. Focus on the really good companies. And Wayne just showed some good traits, some good tools, and diversify. Don't put all your eggs in like 1 or 2 stocks. Have a variety of different stocks, or if you have funds that are diversified, and realize sometimes the short-term uncertainty, it's not an easy or clear path through the uncertainty. And I think that is certainly the situation right now. Thank
you. I've got a member here who basically sold all their stocks back in February. And now they're trying to decide when to get back in. What kind of advice would you give to deal with either that fear or the notion of when is it, because we know that any kind of in and out transaction has 2 components, getting in and getting out. Any kind of thoughts as far as how a member can go ahead and handle that notion of getting back in the market?
I think dollar cost averaging comes to mind. It's because you don't know, you don't know if we're at a bottom. You don't know if the markets can continue to go down. But if you've reached a point where you're thinking about starting to get back in the marketplace, I think it's the dollar cost averaging and just those regular inputs, injections back into the market. So, some month to month or quarter to quarter, things are going to average out. But I think that's probably the method that's probably going to be most systematic and will allow you to sort of slow walk your way back into the marketplace.
I would agree with that.
Oh, let's see here. So if a person's a dividend investor here and they think it's a great opportunity to buy some value stocks, should they focus in on buying individual stocks or buying a dividend-focused mutual fund or ETF?
There's pros and cons of both. If you buy a dividend-focused mutual fund or ETF, you get a broad basket in one swipe. The advantage of buying dividend stocks yourself, though, is you have better control over the taxes. You can actually also look over a broader universe of stocks. So some of these dividend funds focus solely on large cap stocks, and there are smaller cap stocks that are available. You also want to consider how those funds are market cap weighted If they're market cap weighted, you're going to be tilted more towards the larger companies and less towards the smaller companies. With dividend investing, our portfolio, we do not have any market cap requirements. We tend to skew larger cap because they tend to pay more dividends, but you do have more control over your taxes. You have more control over your ability to rebalance, and you have greater ability to go up and down in terms of size versus a fund. But certainly, it really comes down to what's your comfort level in terms of analyzing stocks, your willingness to pick stocks versus there is a certain ease with buying funds, but you do give up the ability to do some customization and go outside the parameters set up by the fund itself.
And beyond even just selecting individual stocks, it's having the comfort and the confidence to actually then manage the portfolio going forward as well.
Agreed.
You know, one of the couple of people have made mention here are concerns over the fact that, you know, over years, partially because of the deficit, trade deficit with many countries, a lot of foreign countries have a high level of investment in our markets, treasuries and whatnot. You know, how concerned should they be, or should we be as investors, that you know, the treasuries may no longer be the safe haven investment, or the dollar itself may be weakening? Should people act in any way about that, or what are your thoughts?
I think you need to consider the liquidity of the treasury market versus the rest of the world. There isn't really a good substitute for the U.S. Treasury market, and so and the dollar is still the reserve currency around the whole world. So you look at China, you look at Europe, they do not have the size and liquidity that the U.S. has, and certainly anything beyond that gets even smaller. So, you know, if we're talking a multi-decade scenario, anything's possible, but I think for the foreseeable future, it's just really hard to replicate the size and the liquidity of the U.S. Treasury market.
You know,
Now, Charles hit the nail right on the head. It's, you know, if this does happen, this isn't going to be something that happens overnight. This is going to be something that's going to have to unwind over a very long period of time.
Douglas was wondering, it seems like a lot of the conventional wisdom, a lot of the historical evidence we presented, it feels like it's based upon conventional markets. And, you know, I think we've said in many ways the current crisis or financial situation is somewhat a politically conceived environment. How does that change the comparability of historical examination, or the history itself contain examples of political issues?
I mean, Nixon taking us off the gold standard comes to mind. That was a particularly, you know, we've had issues with currency in the past.
I mean, I think also it doesn't matter what's driving the markets or what's driving the volatility. It's, you know, it's still having that plan is, you know, relatively agnostic. You know, it's knowing, you know, these are the specific types of stocks that fit my personal investment philosophy, my risk tolerances. So, you know, what's ever driving the volatility in the marketplace, you know, that may be changing. But, you know, knowing that this is what I'm going to buy, this is what I'm going to buy, and this is what I'm going to sell at given points in time, I think that's constant.
Yes, absolutely.
Yep. Staying within your allocations.
Just a little bit further color on the impact of missing 3% days. Any further example? I mean, it's, just a couple members having a little bit of understanding of what that means. Is like the clustering of days. Is that what's the key takeaway there?
Yeah, I think it is easy to get caught up in the impact and the overall performance. You know, that's probably that's sexy. But yeah, at the end of the day, what the biggest takeaway from that whole discussion of the 3% days is the fact that they do tend to cluster. And so it is because of that, it's very difficult to be able to time entries and exits into the market to avoid or to capture those up 3% days or those down 3% days. And so the biggest takeaway from that is, at the end of the day, it's having that patience and that discipline to be able to ride through the market turbulence. Because if you're able to stick with that over the long term, you're going to be rewarded by that patience.
Thank you. And I know we're running a little bit late, so probably just a couple of last questions here. Let's see here. Sorry. If someone's really concerned that we don't enter into another lost decade, is there any ways to determine that? What's the best way to handle that whole notion of a long period of time where we enter a period of stagflation or economic weakness?
Well, I think one thing, when you look at the last lost decade, had you just rebalanced, you have come out ahead. Small cap stocks did really well. I think in any given market environment, there are certain stocks that do well. Diversification certainly helps you get exposed to them. But what I said earlier, the market's not the S&P, the market's not the Dow, and very often when they talk about lost decades, they often focus on large cap stocks and not the broad market as a whole.
Well, building on that, what role, if any, do foreign stocks have in the equation?
It's interesting. Foreign stocks are currently undergoing their longest period of underperformance relative to U.S. stocks in decades. So if you consider that there's a pendulum that it probably has swung too far in terms of the U.S. and out of favor of Europe, but obviously trades it's global now, not just country specific. So there is that uncertainty about if there is a trade shift, what impact does it have and does it spread across? But again, as Wayne said, there's always something going on in the markets, and there are always certain stocks that do well, and investors get rewarded for trying to invest through them.
So what is the best way to invest in Europe?
You can buy there are certain stocks that do trade, European stocks that trade in US either directly on exchanges or some over the counter. I owned Louis Vuitton. It's over the counter, but it's Paris listed shares. But for a lot of people, I think just an ETF or a mutual fund, certainly from a tax perspective, that simplifies things. And you do have a manager who's able to actually buy on the foreign markets.
And I'm going to close on this question here. So how does someone minimize their losses when they're planning on buying a house with stock proceeds?
Oh. They're trying to minimize the loss on their stocks then to have the down payment. Is that the?
Well, I guess the lesson there is that if you think you need the money, in the short term, I guess you should, no matter what, move out of the stock
risk
market.
and
Yes.
Yeah. Move to something a little more conservative.
Otherwise, you're going to have to adjust your timeline. Yeah,
exactly. Or the type of house you can buy.
Yeah. Well, again, thank you so much. There's a lot of questions here, very specific ones. We'll do our best to answer them as we move on. But with that, I know we've gone a bit over our time, and thank you for your patience. I know it's been glad that we've kept so many of our members on here. Jenna, any closing items you want to talk about?
Yeah, of course. I just wanted to first off thank you so much to all of our analysts, Charles, Cindy, and Wayne, as well as John, our wonderful moderator, for a fantastic presentation. It was very comprehensive. We have a lot of compliments coming in through the chat, just at how much information we were able to cover. And I just wanted to say thank you first and foremost. And then I just also want to talk about a little bit. So I know our audience appreciated, all the content that was shared tonight. And of course, as a younger investor going through their first major hiccup, market hiccup, I know I especially did. And then I just wanted to share a little bit of information about how AAII Platinum can offer support in uncertain markets. I know we shared a lot of tools. Wayne went through all the various AI tools, especially the ETF comparison, the ETF screener, and those are some of those benefits can be found in AAII Platinum. And I've mentioned this in the chat earlier as well. But AI Platinum is kind of our one-stop shop for investment resources, ideas, insights, and of course tools. And then with AI Platinum, you can get access to all of our model portfolios and newsletters, plus A+ investors, stock, and fund tools that were mentioned earlier. And then the Platinum dashboard puts all of our strategies and products in one convenient place, making it really easy to find everything you need. And then My Portfolio makes it convenient to monitor your investments and all of your stock ideas as well. And then you also receive like dedicated weekly emails, special reports, analyst commentary, which helps you stay ahead in any market. And then to put it really simply, Platinum is really our ultimate investing toolkit. And then if you're interested in joining, you can get a custom discounted rate on a 1-year AAI Platinum subscription. So you can visit aai.com/platinum-upgrade. And I put that in the chat, and then we'll also include that in our email that we send to all who attended today. And then if you're an AI member with 1 or more subscriptions and want to upgrade, our system automatically factors in those and applies a prorated discount towards your Platinum upgrade. And then we know, these resources can really make a difference when you're investing and conducting research, especially during times of market turmoil. But if you have any questions, of course, we're here to help. Feel free to email us at members@aaii.com, or you can call us at 312-676-4307, Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then I also just want to ask, if any of the analysts have any last remarks or comments that they want to make to the audience.
Well, again, thank you so much for tuning in. We do appreciate all of the contribution, the interest that you guys have shown. I think education is the best tool we could use to arm ourselves to reach our long-term financial needs. Education gives us understanding of what to do, when to do it, how to do it, and how to minimize the mistakes that we make every day. The world is always changing. I know too often it's this time is different comes to mind, but more often than not, we find out that in reality, we've experienced something similar to this in the past. And no matter what, I do have faith in the U.S. economy to work its way out of this problem like it has in the past. So again, thank you for attending. It's best to take a long-term perspective on the markets, and I think educate yourself as much as you can.
I couldn't agree more. And then I just want to also remind everyone, because I've seen a couple comments and questions come in throughout the webinar, and we addressed it earlier. I think John even talked about it, but lastly, this presentation was recorded and a replay will be available at aaii.com/webinars later this week. And then webinar attendees will receive an email with the link in the next few days. You'll also receive a copy of the presentation slides, and then any other resources that we put in the chat or that we find later on that we think will be helpful, we'll add that all into those emails that we'll send out later this week. And then all those resources, the presentation slides, the recording, everything will be available at aaii.com/webinars as well. And with that, we wish all of you viewing good health, good fortune, and a great rest of your evening. Thank you so much,
Thank you so much.
care.
Take care.
Take care, everyone. Good night.